Hi there, welcome to the second part of this lecture, which is going to be dedicated to bond pricing and looking at how bond prices change throughout the duration of the bond. We also look at the likes of the yield to maturity to work out the returns. This part of the lecture, the slides are designed to be rather readable. We go through the formulas, we go through the proofs to show how bond prices are calculated and yield maturities work. However, in this video I'm going to show you the Excel ways of calculating bonds to be a bit more visual and understand how the maths works. But the slides are rather readable, therefore you can read through the proofs and go through the slides one by one to understand how things work out using the textbook formula. But the basic characteristics of bond pricing is that every bond has a face value. That's the value written on the bond that is received at the end as the last payment. But during the bond's lifetime, you are paid a coupon. And this coupon is the interest rate. Typically, bond interest rates are fixed interest, and that is a fixed amount and it will not change. However, you can get index-linked bonds or variable bonds, but this depends on the characteristic of the individual product. But typically, most gilts, government debt, is fixed income paid semi-annually. Depending on which textbook you read, you may see these terminologies different. However, if you ever see the concept of dividends, this may be from an American point of view, and typically we associate dividends with equities. Before we go through the Excel spreadsheet, let's have a look at a simple interest and a simple bond example with the proof. So let's assume that we have a 1-year bond. Now, as I mentioned earlier, bonds typically last longer than a year. And this bond has a par value of 1 million and a coupon rate of 50,000. Therefore, the coupon percentage is 5%. Now this bond has a simple timeline. So the timeline is an annual coupon, therefore you'll buy the bond at the start of the year at time 0, then at the end of 1 year what you will receive is the par value back, the 1 million, plus the 50,000. So if we look at this formula at the bottom half, the first part of the formula to the left is the coupon payment discounted back to time 0. The second part of the formula is plus the redemption, so the par value factorized by the yield to maturity, again discounted back to today. Essentially, to work out the price of this bond, all we're saying is how much is this 1,050,000 payment in a year's time worth today. So it's a present value calculation. So let's assume that the market rate is the same as the coupon rate. Therefore, the discount factor is also 5%, which is the same as the coupon payment. And if you were to do the maths in the formula below, you can see that on the left we have the 50,000 discounted by 1 year at a discount of 5%. Second, the right hand side, similar to for the £1 million discounted at 5%. You can see that in a year's time this 50,000 is worth 47,000. Obviously slight, the million par value is worth 952,000. And if you combine them together, then that equals a million. So that was saying that today the price of the bond to buy today would be £1 million, and then in a year's time you'd receive back 1 million plus the 50,000. And this is not surprising. And this is because the discount factor we applied and the coupon rate at 5% was equal to one another. Therefore, when we discounted the cash flow for years' time by the same discount factor, then that's why the bond price today is the same as the par value. So now let's try and work out the current yield. So again, we're going to assume the same product, that we have a 1-year bond issued in the primary market at day 0 with the same characteristics as before. So if we look at the formula below, what is the current yield? Well, the current yield is the coupon interest divided by the price of the bond times by 100. We already know the price of the bond, we've just worked that out at 1 million. We know the coupon payment is 50,000. If we do the brief quick maths, quelle surprise, it's also equals 5%. Just a few things to know on that brief example. Obviously, we do not know the company's tax position, therefore any sort of coupon payment in this calculation we do before tax. In this example, we had the current yield and the rate of return being exactly the same, but it is worth knowing that the current yield calculation makes zero reference to the time value of money, the cost of actually holding that bond. So it's assuming there's no holding costs. And because of the numbers in this calculation, with the yield to maturity and the coupon being exactly the same, this typically wouldn't happen in practice. And now if we look at the yield to maturity, which is in other words saying the return until the bond expires, we can see the formula here is the current yield that we've just calculated plus the par value, now that's fixed, minus the price at when you were to buy the bond, if you were to buy it in the secondary market, divided by again the price. So effectively par minus price over price is also known as the holding period return formula. So the holding period return formula times by 100, then we divide that by the number of years to maturity that's left on the bond. And again, the numbers are very simple here because we know the par value is 1 million, we know the bond price at the start is also 1 million, and as you can see, the current yield we worked out at 5%, the right hand side of the formula cancels itself out, thus the yield to maturity is also 5%. But we have to remember that this example is just simple 1 year and that we did the yield to maturity and the current yield at the same time at day 0. But later on, if we're halfway through this product, then the yield to maturity will definitely change because you'll be discounting not over a year, it might be over half a year. And it's worth pointing out this is not the rate of return of the bond. So as you can see, this rate of return formula is slightly different. In the last calculation we used the price and the par value in the formula, but in this one we're using the coupon payment plus the price at the next period, in this case it is actually the par value, minus the price of the bond when it originally started. Or if you were to buy this at a certain point in time, the bond price at the market price you paid on the secondary market. And if we include the coupon payment here, then this would ensure that we gain the full rate of return of the bond. So let's now look at it in practice and just recap that in Excel. So here I have a simple example. So I have a 5-year bond. And I've drawn the timeline out, so if you buy the bond over here today, and the bond is a 5-year bond with 4% annual coupon, and the bond is £100 par value. What this means, because it's simple interest, is that every year you'll receive £4, and then obviously in the final year you'll receive the 100 par value back. Now we need to work out the price of this bond, and this is what that formula is all about. And this sigma is the sum of all discounted cash flows. And for this we need a yield to maturity. Now typically in the real world, yield to maturity is the market rate or potentially the market discount rate. For argument's sake, you could use the likes of the Bank of England base rate. But obviously, you would go to Bloomberg if we're looking at actually specific bonds, and it will also acknowledge what the real yield to maturity of that bond actually is. At the bottom here, I broke this formula down. So we've got payment 1. So all I've done is I've got what is this £4 worth in 1 year's time, discounted with yield to maturity of 2%. So that's say £4 in a year's time today is worth £3.92. And that's all I've done here. And as you can see, it decreases as time goes on. And then on this last equation, we have the £400. We have the £100 par value plus the £4 last coupon payment, and that £104 is worth effectively £94.20, discounted back to today. And simple maths, the sigma there tells you we need to sum it all up, and therefore the price of the bond would equal £109.43 in the market today. On this next slide, I have an example of actual real bonds that I've taken from Bloomberg, and the terminologies at the top is how you typically see them in the financial press. So UKT stands for the UK Treasury, coupon of 4.75, and this is when the bond expires in the year 2030. We have a similar bond here, again from the UK government, the coupon of 4.25, also ending a little 2 years later. And this one where it just says T, that symbolises the US Treasury. And again, this ends in 2030. But because these are government debt, they're typically paid coupons semi-annually. So for argument's sake, in this example, I've suggested that we bought these bonds at the start of the year prior to the COVID pandemic and used the interest rates at that time. And because it's paid semi-annually, essentially I've used the time scale here to work out how many payments we actually end up doing. So in order to work out the market price of this bond, we have to work out how many periods there's going to be, given that they're semi-annual payments. And because we know they're simple interest, we know the coupon rate is, this one will give you £4.75 every year. If we were to divide that by 2, then technically every half year you'd get £2.37.5. And we have to present this cash flow for the number of periods up until the coupon maturity date, and obviously the last payment being the final coupon and the par value. So I've tried to simulate that here. This is what the investor would see as the cash flows. And then I have discounted them back to today using the same formula as before. But the yield to maturity I used was the Bank of England base rate at the time, or at the start of the year, essentially, to give an idea. I could have also used the likes of inflation. It depends on how you do this as an investor. And then at the end you can sum them all up. And then this suggests that if you were to buy this bond at the start of the year, the market price of the bond should actually be £140.33. Now that doesn't surprise me. You're probably thinking, well, that's quite high because all you get's £100 at the end of it in 10 years' time. But if you look at the coupon's 4.75%. The Bank of England base rate's 0.75 at the time of this. The market rate is really low, therefore this bond rate is quite high. It's going to be rather attractive. People are going to want to get this because new bonds that get issued now are going to have nowhere near a coupon rate of 4.75. The coupon rate is going to be 0.75. So because the market rate is much lower, then the bond price would be typically higher. So that goes back to the inverse relationship that we mentioned in the previous part of the lecture. You can see here this longer dated bond, even though it's got a slightly less coupon, it's actually a little bit more expensive. And that's because it still has a few more periods than the bond on the left hand side. Because it has longer to maturity, then the price potentially could be higher. That also links back to what we said earlier in the fact that bond prices move more the further away from maturity they are. And as you get closer to maturity, the bond price should converge towards 100, or the par value. And if you go over the US, bear in mind I've used US dollars to price this one. You're probably thinking, well, actually that bond price is quite high. But if we look again at the level of coupon, it's up at 6.25. But I have used a different yield to maturity at 1.5. So as an investor, you think, well, should I go for the UK one or should I go for the US one? Well, there's more sophisticated calculations like duration that we could do, but also we need to factor in foreign exchange rate risk and that the fact that interest rates or market interest rates in America at the time of this were a bit higher than the UK one. So let's have a look at the secondary market now. So I've got, again, a similar example. So I've got a bond that pays a coupon of £100 and the par value is 1,000, therefore the coupon's 10%. What I've said here is we bought this bond because, I've used, again, 10%, I've used discount factor, a market rate at 10% at the start, then the value of the bond at the start would also be the same as the par value, just like the very first lecture example. So if we plot that out, you can see there that the price is 1,000 because the yield to maturity and the coupon's the same, and you can see the cash flow payments 100, 100 up to then 1,000 and 100. But in this example I've simulated that the market rate has gone up. So between year 0 and the first year, the market rate has increased. It's gone from 10% up to 11%. So because the market rate went up, therefore the bond price should come down. So over on this side, I've simulated this. So you've got obviously only 4 years left now. So 3 coupon payments plus the par value and last coupon payment at the end there. And I've used the discount factor of 11% here rather than 10% before. And what you can see is that the bond price has dropped significantly over that 1 year due to that rise in market rate. So interest rates went up, bond price went down. So that's what I've tried to simulate there in the secondary market. And within this lecture, there's another written example from the secondary market here. So we have an example where it was a 10-year bond, but we're approaching this with only 8 years left. So you're buying this bond in the second year, but you're only wanting to hold it for 1 year. And the rest of this lecture you can have a read through, and we try to calculate what is the yield to maturity, the current yield, and the rate of return if we were to buy this in year 2, then sell it in year 3. And you can have a read through this slide and try to understand the maths. And I would highly recommend that you try and practice it yourself, or get Excel up and try and replicate the same example. But I hope that was a quick overview of bond pricing, and that you're able to read through the slides, practice the mathematics, go through the Excel spreadsheet to see how it works and see how Excel also links back to the formulas of this PowerPoint. And we will do a range of different practice questions in the seminar and prior to your examination. Thank you for watching.